Now, selling naked puts can make money whether a stock goes up, down, or sideways. It's a perfect strategy for uncertain markets, especially when implied volatility levels are high. There are so many wrong ideas about selling puts and how to do it properly. Investors cost themselves money by either not selling puts properly, managing the trade incorrectly, or just plain not even using this incredible strategy. Hopefully, in this video, we can help you determine an approach to selling puts that works for you. I'm going to start this video with a simple overview of how selling puts works, then lay down some basic ground rules for this strategy. Then I'm going to explain how to properly manage a sold put and hopefully, along the way, clear up some of those misconceptions that many traders have. To start off, if you're familiar with covered calls, you're actually already familiar with selling naked puts, you just may not know it yet. The mathematical concepts involved in selling naked puts are identical to those of selling covered calls. It's pretty important that you understand covered calls if you're going to be an option trader. If you're not already familiar with covered calls, I'll post a link to our video on covered calls in the description below. I'd really suggest watching it because it's awesome. This actually brings up one of the biggest myths that I see in option trading. I constantly hear that selling naked puts is incredibly risky. Slow down! But covered calls are conservative and a safe strategy.
Sure.
Well, this couldn't be further from the truth because they're actually the exact same. Now, let me demonstrate this with a visual. On the right is a profit and loss graph of an at-the-money covered call. On the left is the profit and loss graph from an at-the-money naked short put. They look identical. If we overlay the two graphs, we can see that they're actually pretty much the exact same. Now, how is this possible? Through a concept known as put-call parity. A put-call parity basically requires that call and put options with the same strike and the same expiration on the same security must have the same risk-adjusted premium. I'm not going to dive deep into put-call parity right now because that's a whole other video that requires a lot more math, and we can explain how covered calls and naked short puts are identical without actually having to dive into all that math. In a covered call trade, you own 100 shares of stock and have agreed to sell it at a specific price. Well, let's say you bought the stock for $50 and then sold a 50 strike call on the stock and you received $2 per share for selling it. Well, the worst case scenario in that trade is if the stock goes to zero, you would end up losing $48 per share. The most you could profit would be the $2 credit you received. Well, in a naked short put trade, you agree to buy the stock for the strike price of the put option. We're going to use the same numbers in our example, so we'll say it's a 50 strike put. If you sell the put for $2 per share, the worst case scenario would be if the stock went to zero. Oh, this is because you've agreed to buy the stock for $50 a share. If the stock becomes worthless and you have to pay $50 for it, you would lose $48 per share. The $50 you lost on the stock minus the $2 credit you received. If the stock stays above $50 per share, your sold put would expire worthless and you get to keep the $2 premium. So as you can see, the two trades are actually identical. Now, I do have to disclaim here that there are situations where a surface comparison like this may not work out to be perfectly even. For example, if there's an extreme volatility skew or some other situation where calls are trading at a significantly different premium from put options. But the point is that selling naked puts is the exact same trade as a covered call. Same risk, same reward potential, and the same Greek profile. Once you understand this, the rules for selling a naked put become very similar to the rules for selling covered calls. So how do you sell naked puts? There are two considerations: the strike price and the expiration. Well, let's talk expiration first. Remember that the money we're making on this trade comes from selling the volatility premium of the option. As time goes by, The volatility premium loses value to time decay. The faster that premium decays, the faster you make money. Well, knowing that, your first instinct may be to sell very short-dated options because they decay the fastest. Well, the downside to that approach is that shorter-dated options have lower premiums to begin with, and you may not be making much money for the risk that you're taking. Well, selling longer-dated options brings in a higher upfront premium, but time decay moves much slower, and so you actually have to stay in the trade much longer to be able to keep any of that premium. I'd suggest starting with selling puts about a month to 45 days out and experiment with an appropriate time frame that works for you before you use real money. Well, picking a strike price can be done many different ways, but the rule is actually pretty simple. Sell a strike that you're comfortable paying for the stock. For example, if you're comfortable with paying $30 for the stock, sell the 30 strike put. Well, let's illustrate this using an example. Here we have a stock trading for $40.68. Well, let's suppose that we're comfortable paying $35 for this stock because that was about its recent low and we don't think it'll go much lower. We would go to the option chain and sell the 35 strike put. We're bringing in a credit of $1.22 per share. The margin requirement on this trade would be about $367 based on typical margin rules. The most we could profit is the credit we received, and the most we could lose is $3,378 if the stock went to zero. Ideally, what we want is for the stock to stay above $35, the option to lose value, and for us to profit on time decay. Well, there are some important guidelines to consider before placing this kind of trade. Number one, do not sell puts against a stock that you are not comfortable owning. If you sell naked puts on a regular basis, at some point you're likely going to get the stock put to you. In other words, you're going to have to buy the stock. And you better make sure that you're comfortable owning that stock at the strike price of that put, even if it means you are in a losing position. Number two, just like covered calls, the stock is the primary driver in this trade. The put is just a source of income. The biggest risk in this trade is if the stock crashes. You need to have pre-established rules for when you're going to get out of a losing trade before getting in. In the case of a naked short put, you should have an exit for a loss strategy based on the stock price moving against you. Number three, put management. Well, you could just let this option expire worthless if you're okay with the risk of potentially being assigned to the stock. But as you get closer to expiration, that actually makes less and less sense unless you genuinely want to own the stock. We'd suggest that you buy the put back when most of its extrinsic value is gone in order to collect your profit and move on safely to your next trade. Now, selling naked puts can make money whether a stock goes up, down, or sideways. It's a perfect strategy for uncertain markets, especially when implied volatility levels are high. Before using it, keep in mind, of course, the risks that we laid out in this video. As with any strategy, we always encourage you to paper trade and find an approach that works for you. Remember the tips I've suggested. If I left anything out, or if you have an approach to this strategy that you prefer, I'd love to hear about it in the comments below.